Hi, everyone. This is Brian Mackey, Deputy Director of Research at Advisor Investments, and welcome to another episode of the Advisor You Can Talk To podcast. Today, we're going to talk about one of the most important factors in determining how much a company's stock is worth, their earnings. We're going to cover all the bases from what is and is not included in earnings to why Wall Street is so focused on quarterly profits. I'm excited to be here with Kate Austin, who is an equity research analyst at Advisor Investments and a member of our dividend income team. Kate earned her MBA at Boston College, where she studied Warren Buffett's highest-grossing investments. At Advisor, she spends her time researching underappreciated dividend-paying stocks. Kate, welcome to the show.
Thanks so much for having me. I'm super excited to be here and talk about earnings. I always say earnings season is the most wonderful time of year, but unlike Christmas and Hanukkah, it comes 4 times instead of just 1.
More gifts. All right, so let's start with the basics. What are earnings?
So the easiest way to think about earnings is just think profits. Earnings are the way that investors measure how a company has done over the past quarter or 3 months. Profits matter because that's what's going to drive a stock price either up or down, since the value of a stock today is all the future profits from that company. A famous portfolio manager from Fidelity, Will Danoff, always says that a stock's price follows its earnings. So the best way to think about this is through an example. If you think about a company like Macy's, they might sell a t-shirt to you for $20, but there are more costs associated with that $20 than just the cost of the materials that go into the t-shirt. You have to also think of the salary of the person that sold you the t-shirt, the rent on the building that Macy's is sitting in, the cost of the shipping that shirt from wherever it was made to you. So all of those costs have to come out of the $20, and so Macy's may only keep $1 of the $20. But that $1 is the earnings or profits, but on a much larger scale.
Yeah, so it sounds like the shareholder cares about that $1 in profits from Macy's because out of $20 that Macy's might get from that shirt, $19 is going to other people. And as a shareholder in the stock of Macy's, you care about what's the profit available to the equity shareholders.
Exactly.
And so you might get $19 going to other people, but that $1 and where if that dollar is going to grow is what really determines what the stock price of Macy's should be.
Exactly.
Okay. And so you mentioned that every 3 months or so, a company will report their earnings, and there's some volatility that we tend to see that the stock might be up or down a bunch after they report. So why is that, and why are expectations in earnings so important?
So typically management will give investors and analysts what we call earnings expectations, or where they think earnings will come in, and it's typically a range. They give it to you for the next quarter as well as for the full year. And this is where analysts kind of build what we call earnings expectations. So they'll take what management will tell them and then, put a shrewd eye on it and put it against their models of what they think is going on with the business and come up with earnings expectations. The reason why everyone cares so much about expectations is because whether a company will miss or beat their earnings expectations will really have an effect on the stock price. So you may remember at the beginning of 2019, Apple guided their fourth quarter earnings estimates down significantly due to slower than expected iPhone sales, and subsequently the stock fell about 10%. Since then, the stock has recovered, but this is an example of how earnings and earnings expectations can really affect stock prices. So an earnings beat or a miss is against those expectations.
Mm-hmm. It reminds me growing up with my sisters, and my parents would expect my sister to get an A, so when she came home with a report card and it had an A in it, that was not a big deal. But if I came home and had an A, it'd be a steak dinner for the Mackey household that night. It was a big deal if a B student came home with an A, and that was just expectations being reset in the Mackey house. So
Exactly.
The same thing happens in the stock market.
Exactly. And your parents are the typical investor. So if if your sister comes with an A and that's kind of what analysts were expecting, the stock might move a little bit. But if, you came home with an A or a C, that would be something significant, and the stock price would move kind of
up or down
based on that. Exactly.
Yeah, okay. Interesting. So what about Wall Street then? You mentioned there's this three-month period where companies are reporting and there's this volatility. Is Wall Street overly focused on quarterly profits?
Yes, but Wall Street is focused on quarterly profits because they have a much shorter time horizon or holding period than your typical long-term investor. And when we say Wall Street, we do mean the investment community at large. But like we talked about, Wall Street is really focused on earnings because that's what your typical investor will get. But the holding period is really the bigger difference. So Wall Street tends to only hold investments for maybe 3 or 6 months at a time, where here at Advisor Investments, we are long-term investors. So we might hold a position for maybe 2 to 5 to 10 years. So earnings are a good snapshot, but again, it's only showing a 3-month period. But this short-term mentality can really kind of miss some of the overarching changes in the world and the business model in general. So a few quarters ago, Netflix missed earnings estimates due to lower subscriber growth than expected, and subsequently the stock fell about 25% from its high. But then the next earnings season, the stock was up significantly due to better than expected subscriber growth. So companies will have ebbs and flows, and this is normal. But because Wall Street has a short holding period, they like consistency. And that short-term mentality really punishes the company's stock price when they do miss earnings, because the future earnings of the stock are coming under pressure, which will in turn put pressure on the stock price. Remember, a stock's price follows its earnings.
Yeah, so it sounds like Wall Street is focused on earnings, but earnings are important, so they should be focused there. The bigger issue is that they're just more focused on the short term as opposed to being a long-term investor, which is what we try to do here.
Exactly.
Okay. So we talked about why earnings are important, but maybe we should focus a little bit on what is not included in earnings.
Yeah, so earnings is one snapshot of how a business is doing, but it really misses 2 key factors: reinvestment in the business and actual cash coming in the door. So these are not captured in earnings, but they are arguably just as important. If you think about a company that doesn't reinvest in its own business, it won't be successful in the long term because they'll become obsolete and their competitors will overtake them. And a company that doesn't have cash flow is not a sustainable business. So there's a company, you may have heard of them, GE, that was always really focused on earnings, always beating earnings by maybe a half a penny or a penny a share. But you looked at how they were reinvesting in the business or how much cash they were generating, and it really wasn't in line with how well this company or how well this stock was performing. For a company like GE, we would expect them to reinvest in the business if they were to, build a new plant to make more power units or purchase another company that's doing that really well. And, obviously because they pay a dividend, you want to make sure that GE is spitting off enough cash to cover the dividend because that cash is going out the door every single quarter to shareholders. So because GE was not reinvesting in the business, they were overpaying for the mergers and acquisitions activity, and they were having cash come out of their books every quarter to pay the dividend. They were really eating into their cash reserves, which is obviously not a good sign. But because they kept beating earnings, the stock price kept increasing. And it really wasn't until the beginning of 2017 that investors started to see the writing on the walls and realized there was a lack of cash, an overpayment for some of this acquisition activity, lack of integration of those acquisitions, and the lack of reinvestment. And since then, the stock has fallen almost 70%. So
yeah, it's amazing to compare the story of GE to that of Amazon, where if in the mid-2000s, both GE and Amazon stock price were doing pretty well. However, GE was doing well because they were beating earnings expectations, as you mentioned. However, Amazon was just growing very rapidly. They weren't making a lot in profit. And analysts were saying, why don't you return that profit to shareholders or buy back stock, pay dividends, those types of things. However, they weren't doing that. They were reinvesting their money in the business. And fast forward to today, and Amazon's done incredibly well. They're one of the most valuable companies on the planet. Their stock has done very well. On the other hand, as you mentioned, GE stock not so well. And so really that focus on the long term is very important.
Definitely. And I think, when you look at both of these businesses, like you were saying, today I think it's abundantly clear which business you'd rather own. It's definitely Amazon over GE. But if you rewind back to the mid-2000s, both of these companies looked like really great companies. So especially on just the earnings. It's only when you kind of got under the hood of the car and started looking at what was actually happening in the business that you could kind of see some of these differences. And I think it's important to remember too that when you do buy a share of stock, you're buying a portion of that business, and by extension, a portion of that company's future earnings potential. And so I think it's really important too to make sure that whomever is at the helm of the business that you're purchasing has their goals really aligned with you as a shareholder. Jeff Bezos, a lot of his net worth is tied up in Amazon, so his interests are aligned with long-term shareholders versus another CEO of GE, John Flannery, who may come in for a few years, try and do the best that he can, and then leave. So he's probably focused a little bit more on short-term investments over the long-term health of the business.
Yeah, it reminds me of a saying that we have here, we eat our own cooking, where when we look for mutual fund managers, we want to know that the manager has been running that fund for a long time and that they are invested in that fund. And that's sort of a lot more like Jeff Bezos versus the John Flannery that was only there for a little bit, probably didn't have a huge stake, certainly didn't have a 16% stake in the company like Bezos did. And you see the results, the short-term versus long-term outcome.
Exactly. And I think, it brings in another point of another former GE CEO, Jack Welch, who always said, show me someone's incentive structure and I'll show you how they're going to act. So it's important to look as shareholders that the CEO's incentive package is aligned for the long term if you are a long-term shareholder.
Okay. So for the long-term shareholders that are listening on this podcast right now, what should they be paying attention to when a company reports earnings?
So it's important to look at the earnings report, as well as some of the other financial statements that will show the reinvestment in the business and cash flow, because those are both very important too. But it is important to look at how this quarter compares with past quarters. What are the numbers saying over a year or two? Is the business expanding or contracting? How is the stock price reacting to those things too? Earnings season is also a great time to chat with management to get some overarching larger strategic goals, what the competitive landscape looks like. But I think sometimes too, a bad quarter can really hurt a company's stock price in a phenomenal business. But this really gives investors a great buying opportunity to take advantage of some of that short-term thinking that Wall Street uses to get into a phenomenal business. So we will expect earnings season to be a little bit more volatile, just because there's so much more information. But it is always an exciting time of year, 4 times a year.
Absolutely. So I guess if I were to take sort of 3 things from our conversation today, I think the first would be earnings matter, right? We wouldn't be having a podcast on earnings if they didn't matter. But if you own a stock, if you're a shareholder in a company, then you're getting the income that is derived from that company. You're getting the profits. So you want to be paying attention to what those profits are. The second takeaway I'd get from this conversation is that companies report earnings every 3 months, and so there could be some volatility. The stock could be up or down quite a bit as the company reports, and expectations are sort of reset every 3 months when a company does report. And lastly, I'd say that while earnings matter, they're not the only thing that matters, that we're also paying attention to how much is a company investing in their business, what is the actual business model, the overall strategy of the company. That'll paint a much more complete picture of what you're investing in.
I couldn't have said it better myself. And, we do want to keep a focus on earnings because, like the wise Will Danoff says, a stock's price will follow their earnings.
Absolutely. Well, thank you, Kate. This has been Brian Mackey and Kate Austin, and we'd like to thank you for listening to another Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe and review our show. You can also check us out at advisorinvestments.com/podcast. We love getting feedback from listeners, so if you have any questions or concerns, please email us at info@advisorinvestments.com. Thank you.